Hi folks. Welcome to Stock Market the Week Ahead video. We have a lot to talk about in this video. We have PPI data, retail sales, few comments from the Fed officials. Also this week market focus shifts from inflation to growth. And for the next week PPI and other important economic data coming. And we also look at the coming week's economic data and earnings. Let's begin. Topics for this video. Let's look at the week's performance. SPX and ES futures weekly lows per my levels. I gave you these supply-demand zones over the last weekend. I had weekly low on S&P 500 at 3,886. What do you think was this week's low? It's 3,885.70. For the ES futures, I gave weekly low as 3,901. The low on Thursday was actually 3,901.75. How about that? It's all given for free. So please share and like, so more people can benefit. Also you can follow me on Twitter for real-time commentary. I posted another video on trading concepts. Whether you are a beginner or have no prior experience whatsoever, or if you are already a trader, and want to improve your trading, this video will help you. Now, back to this week's performance. Today was options expiration and the sell-off over the previous two sessions took the S&P from 4,015 to 3,886 level, holding above last week's low and the 20-day moving average. Dow Jones is down 2.7% for the week and up 0.7% for the year. The S&P 500 down 0.7% for the week and up 3.5% for the year. Whereas Nasdaq is up almost 0.6% for the week and up 6.4% for the year. The international index is down 0.5% for the week and up 7% for the year. Yields are unchanged for the week and down 0.4% for the year. Oil is up again 2.3% for the week and up 1.8% in the year. And lastly bonds are up 0.2% for the week and up 3.6% for the year. As I predicted in my 2023 Outlook video, this year bonds will do good. It was a wild rally on Friday again. So let's take a look at the heat map. It's mixed this week. Apple is up 1.33%, Amazon is down 1.48% for the week. Tesla went up 3.2%, Microsoft down by 1.6%. The financials are down as well after the Goldman Sachs earnings. Let's look at the S&P sector's performance for the week. The growth stocks are up big for the week. Communication services up almost 4% for the week following Netflix's earnings. And also Google layoff announcement. Followed by tech sector also up 1.4%. Industrial and utilities sectors are at the bottom down by more than 2%. Let's look at the sectors for the first 3 weeks of 2023. Leading again is communication services and consumer cyclicals up by almost 10% for the year. Basic materials are up 9%, following China reopen story. Real estate also up by 6.5%. Financials up by 5%. Energy is up by 3.5%. At the bottom are consumer defensive sector. Fed rates remain at 4.5%. Unemployment at 3.5%. Let's look at yields. 1-year Treasury is unchanged since 1 month. 2-year Treasury is down few basis points from month ago. 5-year and 10-year Treasury yields are down slightly. Whereas 30-year Treasury yields are down 0.05 points. Mortgage rates. The 30-year fixed is at 6.33%, unchanged from last week and last month. The 15-year fixed is down to 5.57%. Let's look at the Fed Watch tool. Next FOMC meeting is in 11 days. Money market participants now see a 99.2% chance the Fed will hike the benchmark rate by 25 basis points in February. And chances for 50 basis points fell from 6% last week to less than 1% this week. That explains the rally in the stock market. For the March FOMC meeting, market participants now see 79% chase for 25 basis points hike. There's a 20% chance that Fed will not change the rate, which is actually up from 16% last week to 20% this week. 50 basis point in March is at 0.6%. Market commentary and some headlines. Market focus shifts from inflation to growth. Markets seemed to take a notable turn lower last week after a slew of weaker-than-expected economic data. On Wednesday, U.S. retail sales data for December fell by 1.1% monthly, below the expected 0.8% decline, and at the lowest monthly reading in 2022. This softness occurred during the holiday spending season and indicated broad-based weakness, including in big-ticket items like auto sales and furniture. This was perhaps the first signal that the U.S. consumer is starting to pull back, feeling the impact of both elevated inflation and potential economic weakness. Investors will now be watching to see if this trend continues into early 2023. In addition to a weaker consumer, manufacturing data last week disappointed. Industrial production fell by 0.7% monthly in December, below estimates of down 0.1%, also at the lowest reading of 2022. The NY and Philadelphia Fed indexes indicated manufacturing trends contracted in January, both seeing weakness in activity and new orders. This also confirms an ongoing trend of softening demand for goods, as highlighted earlier in the month by weaker-than-expected US ISM manufacturing data. The ongoing US debt ceiling debate added to investor angst. In addition to the economic data, investors faced myriad headlines around the ongoing US debt ceiling debate. On Thursday, the US officially exceeded its debt limit of $31.4 trillion, and the Treasury began extraordinary measures, including suspending the sale of certain government securities, to ensure the US meets its obligations. Since 1960, the debt ceiling has been raised 78 times in the US, including 20 times since 2001 alone. In the last several instances of more severe debt ceiling showdowns, including 1995, 2011, when S&P downgraded the US credit rating, and 2013, markets were higher in the 12-month period after the debt ceiling was resolved. More broadly, market performance tends to be driven more by economic and earnings fundamentals rather than the political landscape. Earnings have been mixed, but 2023 estimates are moving lower. Finally, markets have been following earnings this past week for any signals on economic growth. About 11% of S&P 500 companies have reported fourth-quarter earnings so far, and results are mixed. Of these companies, 69% have reported earnings ahead of expectations, which is below the 10-year average of 73%. Earnings for the quarter are expected to fall overall by 4% annually, the first negative growth quarter since 2020. The first large-cap technology firm to report earnings was Netflix last week. The company missed earnings expectations, driven largely by currency fluctuations, but subscriber growth came in well ahead of expectations, which supported both the stock and the broader technology sector on Friday. Earnings estimates for both first quarter and full year 2023 have moved notably lower in recent weeks. First quarter growth is expected to fall by 1.2%, well below the expectation of 5.9% growth at the end of last quarter. And full year 2023 estimates now call for 4.0% growth, also meaningfully below the 10.5% forecast as of last September. While earnings revisions may continue to weaken, a first leg lower for 2023 estimates has already occurred. Now let's look at the next week's market momentum or market breadth, and economic calendar and the earnings. Market momentum or market breadth. This is from the Friday's close. It was a pretty good breadth on Friday to the positive side. On NYSE we have 78% advancing issues to 21% declining issues. On Nasdaq we have 71% advancing issues to 27% declining issues. Looking at the moving averages, they all have came down slightly compared to last week. Last week we had 84%, now 51% are above 5-day moving average. Looking at 200-day moving average, unchanged from 58% last week to over 57% this week. So the momentum is still positive, it can support the short-term continued rally. But it is weakening. Now let's look at the new highs and new lows. So similar thing here. In the new highs and the lows a little bit of downtick in the breadth across the board in 5-day, 3 months and 52-week new highs and lows now. Only 13% of the stocks near 1-month highs, and 2% near the lows. So, at least they are holding up well. Economic calendar for next week. On Monday, we have US leading indicators. On Tuesday, we have flash PMIs, Richmond Fed Index. On Wednesday, we have mostly mortgage data. On Thursday, we get job claims, Q4 GDP, durable or capital goods orders, new home sales, KC Fed Index. On Friday, we get the main thing. PCE, personal income or spending, pending home sales, University of Michigan sentiment. Now, let's look at the next week's earnings. This is the January month earnings calendar. We see earnings from some big logos this coming week. On Monday, we have few more banks on the deck. Baker Hughes to show a growth of 9.8%. On Tuesday, we have Johnson & Johnson, Verizon, Lockheed Martin and GE on the deck, as well as 3M. On Tuesday after market close, we have Microsoft, Texas Instruments, Capital One and F5 Networks. Halliburton is expected to post a 30% growth. That's impressive. Verizon is 3.8% growth. I like Verizon as dividend stock in my long-term portfolio. I may sell some puts to capture some premium on Verizon. GE to show a growth of 7%. Look at Old National Bank, growing at 133%. On Wednesday, we have Tesla, Abbott Labs, AT&T, IBM, Boeing and ServiceNow on the deck. There's lot more earnings this week, I'm only highlighting a few. Boeing is expected to post a 35% growth. AT&T a negative 23%, ouch. Abbott is also negative 16% growth. DOJ is doing criminal investigation into last year baby formula shortage because of Abbott's negligence. On Thursday, we have American Airline, Visa, Louis Vuitton, MasterCard, Comcast, Intel, KLA Corp on the deck. American Airlines to post 34% growth. All the airlines posting double-digit growth. On Friday, we have Chevron, American Express, and Colgate-Palmolive on the deck. Chevron to post 11% growth. American Express to post 17% growth. That's all in this video. I hope you enjoyed watching this video and learn what to look forward in the upcoming week. Please drop a like, or share, and subscribe. See you in the next video.